Greetings and welcome to this week's edition of TTG Update. I'm going to dig right in here and show you some charts from this year and this week as we've been doing. This is the stock market as represented by the S&P. And you can see that it has, we had a nice little rally this week. If we were to draw our trend lines, it kind of broke through 3,800, which was heartening to see. It's always encouraging, but it's been on relatively low volume. So we remain very cautious. Nearly about 100 of the S&P 500 companies have reported as of this week. 75% of them have beat earnings, our revenue, and so that's probably why the market's a little bit encouraged. But margins are definitely under pressure from inflation, and so we are still not entering stocks and on any kind of wholesale basis. We're taking a cautious approach. Now, on the other hand, we're going to take a look at bonds, and we're going to do it through the view of three funds. The PIMCO Income Fund, which is one of our largest holdings, sort of an intermediate term bond fund. The LALDX, which is the Lord Abbett Short Duration Fund. And PGX, which is sort of a proxy for all of our preferreds. And you can see that preferreds have rallied very nicely since the middle of June. And this is a logarithmic chart, so you can't tell quite as much, but PIMCO has had a nice little rally as well, a couple of points. And short-term bonds weren't down as much, so they haven't rallied as much, but nevertheless, they've leveled off. This is encouraging to us. It's encouraging to us to see bonds gain some traction, because remember that they're paying their dividends all along. And if they can gain traction and start to claw back some price on top of the dividends, on top of what we bought, we should be in good shape going forward. And so this is a little bit encouraging. And I think that, again, bonds are, although earnings are important to bonds ultimately, you need to earn money to pay your mortgage, right? But short-term bonds are down because of the actions of the Fed. And right now they are baking in about a 3.5% Fed funds rate by year end. That's already baked into the price of bonds. So unless the Fed gets more aggressive, we think bonds may be at or are very close to their bottom or have already seen their bottom. So we're encouraged by that. Now, a couple of other items this week, just housekeeping items. Many of you owned a fund. The symbol was LMBS. That was the First Trust Short Duration Mortgage Fund. And it treated us well this year. We bought it as sort of a proxy to earn some interest, but still hold value. And it's not down very much this year. The reason it wasn't down is they bought insurance on their portfolio. They did this by shorting treasury bonds. And shorting just means you sell something you don't own in hopes to buy it back later at a cheaper price. Well, the problem with insurance is you have to keep buying it for insurance to work. You buy insurance for 5 years on your house and you fail to buy it in year 6 and your house burns down, it doesn't work. So in the case of First Trust, their insurance, a lot of it comes due this September. It's become more expensive, and we think that's going to cause them some difficulty. So it did its job, and we went ahead and sold out of it, and we're looking to buy other short-term bonds, individual bonds, and funds that will increase your dividend and not have these difficulties with this big insurance rollover they're about to run into. So that's a little bit of news this week. Again, we're encouraged by what we see. The trajectory of the income, the hard dollar income in your portfolios, for the most part, is up. And we will, again, as we keep encouraging you, these things will be more valuable in the future than they are now. We just have to kind of hang in there. make good purchases based on reasoned research. And if we do that, we think we'll be just fine. So we hope you find this encouraging. So long, stay safe, and have a great week.